sign of delivering a breakthrough. The limited data we do have is keeping the Fed well on track to cut interest rates.
And look, yesterday's ADP data is controversial, especially with some of the revisions. But what's fascinating to me is how the economic data, the limited that we have, is being interpreted completely differently in the bond market or the stock market. The bond market is saying, oh no, weakness ahead, the Fed's got to cut. The stock market is saying, yay, the Fed is going to cut, risk on. And how much does this reflect two different economies in parallel that the Fed is responding to in one hand and the stock market's responding to in another hand?
Now, typically we'd say, wait for the data, jobless claims, payrolls, to see if it confirms what we got from ADP, but you're going to have to wait a little bit longer. No claims later on this morning. Perhaps no payrolls tomorrow morning at 8:30 Eastern time.
Doesn't look like we're going to get the payrolls report tomorrow. We do not have right now a working framework for Democrats to be willing enough to sign up for the continuing resolution to keep the government open. And I say that because Senate Majority Leader John Thune had this interview with Politico and almost acknowledged that there has been outreach between these two groups and that they would be willing to have a conversation when it comes to health care and these subsidies when they have 8 or 10, preferably 10 or more, Democrats sign up, base a little bit more mass, that they're willing to have a negotiation if more Democrats are willing to keep the government open through this continuing resolution.
Typically, investors don't really care about it. The market looks through it. The economy bounces back. Timing matters. Is it different this time? Neil Dutta, Renmac, had this to say. It's coming at a fragile time. It could go on for a while. Government workers might save more if they think this will happen again. He's a little bit more nervous about the position we're in, the timing this comes at, and what could happen to this economy.
And that's from the economic perspective, and that's without the potential job cuts that we hear being threatened from the White House that could come in the next few days. There's an additional aspect, which is this is a highly confusing moment economically with even less data. We're in a dark room, and now we've got blindfolds on, and now we've got big helmets over those blindfolds. And there's a question here, especially as Austin Goolsbee of the Chicago Fed comes out. Think what you will of some of his proclamations. He said this just makes it incredibly difficult for us to really have up-to-date information as we head into that meeting, as it's unlikely that we're going to be able to get CPI the longer this drags on.
So you've got the data, and then Brammer pointed out you've got the equity market close to all-time highs, at record highs, and then you've got private markets too. Valuations. Do you remember the definition of a unicorn? Private startup, valuation of $1 billion. We've got herds of them now. Check this out. $500 billion valuation for open AI. Just get your head around that. A few years ago, unicorn, super rare. $500 billion valuation for that company.
Yeah, now we're selling My Little Ponies. Look, I'm looking at this and I'm thinking to myself, at what point does this indicate froth? And at what point does this represent the sea change that OpenAI really represented, that catapulted a lot of the tech valuation from 2022 and completely transformed the way that AI was viewed in terms of its potential in this economy? So one of two ways of looking at this is a Rorschach test as people kind of game out valuations of other companies as well.
Nasdaq futures up this morning on the S&P as well, high by 0.2%. Coming up this hour, John Stolfus of Oppenheimer as markets shrug off the government shutdown, Vito Spaduto of RBC Capital Markets on a surge in deal making, and Kelsey Barrow of JP Morgan Asset Management on what labour market weakness means for the Federal Reserve. We begin this hour with stocks rising after closing at record highs. John Stolfus of Oppenheimer calling for a street high 7,100 on the S&P by year end, writing this: economic resilience along with revenue, earnings growth and innovation across the sectors remains key in our view to the market's ability to continue climbing the proverbial wall of worry. John joins us now for more. John, good morning.
Good morning.
Is that government shutdown just another brick in that wall of worry?
I think it's another brick in the wall, to quote Pink Floyd. And that said, we've seen the markets really overcome and traverse hurdles all along this year. And it is indeed, it's the innovation, it's the resilience, and it's a different structure in terms of the market itself, we believe, in terms of participants. You know, the market is not just the guy with the monocle from the Monopoly game, you know. It's all kinds of people. And in the U.S., it's multi-generational people investing for longer-term goals. So the disturbances that are caused by the potential for a short-term or intermediate or longer-term shutdown are of less concern to them right away, as opposed to getting money positioned for goals that may be 3, 5, 7 years out.
Can I build on that, John? Do you think there's some tension between different generations on how they view how this market should be valued? Some tension between the boomers and what they think the appropriate multiple is for this stock market with a different sector mix?
Most certainly. I think, you know, when you look at people who've been, the boomer generation, stocks are cheap at a 16 forward multiple. as you go forward in generationally, people are willing to pay higher multiples for growth. And I believe the reason why, a lot of it comes from Ed Yardeni, who's for years said that the Wilshire 5000, there aren't enough stocks to really qualify that are publicly traded anymore for that indices anymore, because it's, about 3,500 stocks or 3,400 that you actually have to choose from. And the thought is it's supply and demand. It's the basic thing of economics. The demand for your technology, your hyper growers, the ones who are well established, deeply embedded in the lives of both business and the consumer, where we're all on the upgrade cycle, whether we like it or not, as I always like to say. This is what's driving this market in many ways, and it differentiates, not just generationally, but the difference between traders who are looking at risk to capital, capital put at risk on a day-to-day, minute-to-minute basis, and intermediate to longer-term investors. When I started in this business 42 years ago, hard to believe. It's not that I didn't think I'd live this long. I didn't know how long it would happen. But it was the retail investor would always come into the market, usually once the market was up 20% and everybody knew it, and the cab driver was asking you for a hot tip if he saw you had a copy of the Wall Street Journal under your arm. Today, people are very well informed by the financial media. They have all the arguments. You get to see the players actually express themselves, and you see the body language that people are using, and it makes it's remarkably more intimate than it was ever before, and people are better informed and better able to work, we'd like to think, with financial advisors who are working as fiduciaries.
They also are better sold in the story of the hopes and dreams of just how much AI can do. And there is a lot of truth to it. And history doesn't repeat, but it does rhyme. And back in the dot-com bubble, boom and bust, there was AOL. You've got mail. We don't do that anymore. I mean, some people still do, and God bless you. But I'm just wondering, going forward, how do you identify all of the money that's going to be wasted at a time when there's a lot of projections and not a lot of data on what ultimately will happen or how it's going to be applied?
Well, I think for one is if we just go back to as recently as the tech bubble, things were practically primitive versus where we are today. I can remember working at another well-known firm headquarters on Broadway in 1997, and suddenly you would find the internet would go out, and when you would go home to connect to the corporate, you'd have some kind of little device would be and all that stuff. Today, we still have problems with technology, but it's very well established. And the idea is, well, I can remember putting dimes in a payphone. People don't even know what a payphone used to look like. Sometimes I see an old architecture in our building, which another firm had before us. There's actually a group of things, no phone anymore, but what are these things for? They're for the press as they exited to write things down. But where we are today, I think a lot of the stuff will likely prove disappointing, but the core will be, it's already being invested in and utilized to create greater efficiencies.
I guess that you talk about the babies being thrown out with the bathwater. I don't see any babies, and I don't see any bathwater being thrown out either. Nothing's being thrown out. So how do you identify what that means?
Well, I'd say actually on a day-to-day basis, I'm not solely a strategist. I also manage money for the firm, both an ETF portfolio with passive indices and then individual stock portfolio. And we've seen a considerable broadening of the rally that has suddenly rewarded sectors like industrials. We've seen better attention played to utilities, both on, as it looks like the Fed is going to be cutting rates going forward, not necessarily enthusiastically, but on a down payment kind of basis to show that the rate hike cycle is over. What you have effectively is you've got utilities are no longer considered as much of a risk as a bond proxy, because it looks like interest rates are coming down. Healthcare has caught a bid as a result of one company's efforts to reduce prices in the last couple of days. I'd mention the name of the company, but because I manage money, the firm doesn't let me. They don't want me pitching stocks that I might or might not own.
Staying on the Fed, how difficult is the end of October's meeting going to be if this government shutdown is prolonged? We know we're not likely going to get tomorrow's payrolls report, but then what about CPI on October 15th as well? They might not have all the most relevant, up-to-date data.
I think, I think it's close enough to I think we kind of got a fairly good idea that the dot plots showed that there would likely be a cut in October. And I think we're close enough in terms of the data. I think the question would be to December, what's going to happen there? And hopefully by then this will be behind us, this whole question of the shutdown.
John, never mind the bathwater. This has been a pool party now for 6 months. And it's getting wilder. I think spring break. Don't want to go there. Okay. Look at the valuations we're seeing in private markets. $500 billion on a startup. Now, John, I'm just trying to work out, never mind the risk aversion. I don't see any. I saw a bunch of debt issuance in September, and people are starting to get pretty excited about the future still on top of that. When do you start to get concerned?
Well, I play in the public markets as opposed to the private markets.
Doesn't one inform the other right now?
I think to some extent, but the selectivity there and what is chosen to move into the private equity market is not necessarily everything at play. I think that's something to look at as we go forward. And that, as you mentioned, the money that's being thrown at this one particular deal is like, the valuation is rather worrisome, except if you consider how much is already developed. This is this isn't the primitive stage of people saying, someday we will have 1 million eyeballs on our website.
Sure.
This is companies that know you need billions of eyeballs. And you need to be well capitalized, and it's not just well capitalized, but the likelihood of cash flow generation pretty quickly from here to there. Because this week I was at a due diligence meeting at an ETF firm, a management firm that has ETFs,
right.
And their technology people just talking about all the investment that's being made here, but by smart people who are educated and deeply involved in tech for maybe 40 or 50 years.
John, it's good to see you. Always is to get your thoughts. An experience spanning 40 years plus. John Stolfus there of Oppenheimer. Fascinating story just dropping from Reuters. Check this out, the lead paragraph. Eli Lilly was asked to produce more insulin. Pfizer to produce more of its top-selling cancer drug, Ibrance, and its cholesterol drug, Liptor. And London-based AstraZeneca asked to consider a new headquarters in the US, according to two news sources. This dance between the US and the private sector. Trump seeking deals in 20 to 30 critical industries before the midterms. The White House and agency staff are seeking deals that can be announced by the president. Deals include taking equity stakes and regulatory relief in exchange for concessions. That dance has been a dominant feature of this story for the past 6 months.
Sounds like Trump RX wants to expand. Further in the story, they talk about how these executives are getting near daily calls from Chief of Staff Susie Wiles, and it comes at a point where during the shutdown, the debate that Democrats want to have is around health care. And this is something that Democrats actually, one of the few areas right now they are polling better than Republicans. So if Trump can make this a Republican issue that we are delivering, maybe on bringing drug prices down, at least seeing that they are in active engagement with some of these pharmaceutical companies, that could be a political win for them going into the midterms.
That's the latest story from the team over at Reuters this morning. Let's get you an update on stories worldwide elsewhere with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. The White House is preparing for mass layoffs of federal workers as the U.S. government shutdown stretches on. Budget Director Russell Vought told lawmakers that agencies will move to terminate workers within 1 to 2 days, according to people familiar. Details about what agencies or positions would be targeted remain unknown. The U.S. Supreme Court refused to allow President Donald Trump to immediately oust Federal Reserve Governor Lisa Cook as she sues to keep her job. The court's order means Cook can remain in her position at least until January, when the justices will issue a new ruling after hearing arguments over her alleged mortgage fraud. OpenAI's valuation soars to $500 billion. That makes it the world's most valuable startup. Sources telling us here at Bloomberg, current and former employees sold more than $6 billion worth of stock, pushing the company past its previous $300 billion valuation. This all as negotiations are underway with Microsoft to convert OpenAI into a for-profit company. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, bracing for layoffs.
If this thing drags on for another few days or, God forbid, another few weeks, we are going to have to lay people off. I actually don't think it's going to be that long of a shutdown. You already saw some evidence that moderate Democrats are cracking a little bit.
That's up next with Michael Townsend of Charles Schwab, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Typically, given it's Thursday, we'd be about 2 hours away from jobless claims. Not getting jobless claims today. On to tomorrow. Looking for payrolls, 8:30 Eastern Time. Probably not getting payrolls at 8:30 Eastern Time. So your big event tomorrow could be the ISM services at 10 a.m. Eastern Time tomorrow morning. Now, typically, sometimes, that does end up being the bigger event on payrolls Friday. ISM services, big chunk of the economy, important read for the month of September. I'll be glued into that one. Never mind payrolls.
Yeah, that's why I was really excited yesterday for ISM manufacturing, and then it came out and it was just sort of meh. It kind of doesn't give us any clear sense of where things are going. Same with some of the other data that we got ahead of what was supposed to be jobless Thursday and then potentially non-farm payrolls on Friday. I am curious, though, to see whether you are seeing any acceleration or any clarity and how much that could inform what the Fed ends up doing.
The data we have got, ADP, the lowest number since March 2023. Lisa talked about factory activity shrinking for a 7th consecutive month. New orders slipping back into contraction. That was slightly unnerving yesterday. That was bad news, and that was good news for the bond market, and apparently good news for stocks too. Equity futures up again this morning by 0.2% on the S&P, and the Nasdaq up by 0.3. Under surveillance this morning, bracing for layoffs.
If this thing drags on for another few days or, God forbid, another few weeks, we are going to have to lay people off. We're going to have to save money in some places so that essential services don't get turned off in other places. That is the reality of the government shutdown that Chuck Schumer and the Democrats have foisted upon the administration. I actually don't think it's going to be that long of a shutdown because I think you already saw some evidence that moderate Democrats are cracking a little bit.
That was the Vice President of the United States on the government shutdown. Here's the latest so far this morning. The White House and the Budget Office warning the administration will begin firing federal employees due to the government shutdown. Bloomberg's Laura Davison joins us now from Washington for more. Laura, welcome to the program. Walk us through the next stages of this. What happens today, tomorrow, through the weekend?
So as soon as today, we could start seeing some of these mass layoffs that Russ Vought, who's the budget director at the White House, has teased. He is playing very hardball tactics here and is playing a politically astute game. He's not just cutting random spending or looking to cut random jobs. He's looking to cut the government where it most affects Democrats, particularly key Democrats in this fight. So we saw yesterday one of his first moves was to cut infrastructure funding, about $18 billion for New York City. Of course, Hakeem Jeffries, the Democratic House leader, and Chuck Schumer, the Democratic Senate leader, are both from New York. We then saw he cut green funding from only states who voted for Harris. As we move into this job phase, which again could start as soon as today, it's likely that these jobs will be either for programs that Democrats like or in places where Democrats live.
Laura Davison with the latest down in Washington, D.C. Laura, thank you. Michael Townsend of Charles Schwab joins us now for more. Michael, welcome. I just want to build on some of that with you, what you're looking at the moment, and ultimately who's benefiting from any of this in the court of public opinion. Is anyone winning?
Yeah, I think it's really hard to see anyone winning at this point. And, I think the administration is trying these kind of hardball tactics that target Democrats. And I think the question is whether that actually hardens the Democrat position rather than, sort of making them cave. The vice president in the quote you played, referenced that there has been a couple of Democrats that have voted for the most recent iteration of the temporary extension of funding. But it's only been a couple, and they still need several more. From the Republican perspective, they need at least 5 more Democrats to get on board. I'm not sure that these tactics are the way that's going to happen. So I think this is going to play out over a longer time than maybe the vice president thinks.
So when OMB Director Russ Vought, though, gets on a call with House Republicans and says, we're going to have these mass reductions in the workforce, firings are going to begin. Is that going to be legal when the government reopens?
Yeah, I think this is an interesting question about whether it is legal, because typically, as we've gone through shutdowns in the past, right, workers are furloughed, and then, you know, they get their jobs back when the government reopens, and in most cases, they're retroactively paid for that time. So, you know, I think this is like so many things in the administration. It's likely to end up in the courts, and you know, the decision on whether it's legal or not is going to play out in real time, and then possibly after whatever happens with the end of the shutdown. So I think that's an open question.
This is one tool the Republicans are using to try to make this as uncomfortable as possible for the Democrats. We also saw, obviously, the freezing of funds when it comes to blue states, like what's happening here in New York. What else can the Republicans do?
Well, I think, first of all, though, it's important to remember that you can't target just Democratic voters, right, on this. I mean, if you're laying off federal employees, there are plenty of federal employees who live in Republican districts who are Republicans, who voted for the president, who are probably going to be frustrated. So I think that's the first point, is that, you know, you can be as targeted as you want, but you're still going to end up affecting a wide swath of voters than maybe your own voters. And so I think, you know, how the public and the voting public feels about this is going to be something that's really, really important to watch over the next, you know, week or two as this plays out. But I think you're going to continue to see the administration, you know, target programs and areas that are predominantly Democrats. They're going to try to target Democrat priorities to make this more difficult for Democrats. But I think the flip side of that is, do you end up in a situation where you're sort of hardening the Democratic position because it becomes so transparently political, what the administration is doing? So, you know, the dynamics of a government shutdown are always really, really strange. I think this is going to be one of the stranger ones, and we're just going to have to see how it plays out.
Sort of like some of the imagery coming out of the Oval Office yesterday with President Trump and the Democratic leaders that sent a pretty strong message. I guess my question is, you said that some of the hardball tactics could harden the Democratic views. I'm just wondering if you believe that this shutdown could go on a lot longer than markets are currently pricing in and have a greater ramification for the economy.
Yeah, I think there's a possibility. I'm sort of the view that either this gets resolved relatively soon, like, say, sometime next week, or it extends for quite a while, and perhaps, you know, through the month of October. And I think that's going to really depend on where Democrats feel like they can come out victorious in this. You know, this whole battle over the expiring enhanced subsidies for purchasing health insurance through the Affordable Care Act, you know, that's something that there are Republicans that are in support of, and particularly in the Senate, where I think there are Democrats and Republicans talking behind the scenes about ways to get that done. The question is whether, even if you got some kind of deal in the Senate, could that pass the House, where I think conservatives are much more hardline against those. So I think there are a lot of machinations that are going on behind the scenes. Right now, those don't appear to involve leadership very much. But, you know, as shutdowns drag on and the public gets more and more frustrated, maybe you can get to some kind of deal in a relatively short term. But I do think there's a decent possibility that this could last for multiple weeks.
Michael, thank you, sir. Michael Townsend there of Charles Schwab. That's not where this market is. I don't think it's where many people are. Peter Chi of Academy said the same thing yesterday in a note. He said, I wouldn't be surprised if this one lasts weeks or even months and not days.
It really is informed by what happened in March when Chuck Schumer allowed the government to stay open and cut a deal with the Republicans. And then it came under scathing criticism for having folded, not doing enough. And so you start wondering, what is, to your question, the idea of the political blowback? How much is there? And right now, it's unclear. Nobody's particularly happy. You point out airlines. I think that you're right.
Well, if it's prolonged, curmudgeon travelers is what's going to do it. When you had the 35-day shutdown, Trump's first administration, the same day the FAA started closing and talking about delays in some of major airports is the same day Trump agreed to a temporary government funding measure.
Most people I know are curmudgeon travelers.
Everyone's a curmudgeon.
And this is going to make make it that much worse.
Coming up on the program, Vito Spaduto of RBC Capital Markets on a big year for deal making.
said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Four-day winning streak on the S&P 500, the longest steady run in around about 3 weeks. This morning we add to it, up about 0.2% on the S&P, up around 1/3 on the Nasdaq, up by 0.4 on the Russell. Lisa talked about yesterday's bad news being good news for this bond market across the curve, particularly at the front end, the return of the so-called bull steepener. 2-year yields down, a decent chunk. We're back down to the 350s. And this move for gold, what a move for gold. Precious metals taking off this year. We're talking about something like a 50% move year to date. Goldman Sachs, good friend of this program, Dan Struyven, said this in a note: the potential for private investors to diversify significantly into gold presents a large upside risk to a forecast of 4K for mid-26 and 4,300 for the end of next year.
Well, in fairness, we've gotten to almost 4K this year, potentially even at the end of this month. I mean, we've talked about the biggest month of gains for gold going back to 2011 in the month of September. You start wondering why? Well, it's exactly the dynamic you were talking about. The front end of the yield curve is responding to a labor market. The equity market and risk assets are responding to something completely different. You put the two together and it seems like this economy is going to be run hot. It's going to lead to some marginal increase in inflation, and that's going to debase on the margins the dollar even further.
Getting closer and closer to 4K on gold, up again this morning by 0.4%. 3 hours away from the opening bell. Let's get you some single names, some morning movers. Here's Vonnie Quinn with more. Hey, Vonnie.
Hey, John. Yep, I thought I'd start with Tesla because we are waiting for third quarter delivery numbers out this morning. Investors are hoping to be pleasantly surprised, looking for just under 440,000 deliveries, in fact. Now, as we know, the stock has been languishing for part of this year, but since Elon Musk renewed his focus on the company, we have seen a nice run-up. And again, shares pre-market up 1.5%. If we do get something around the 440,000 mark, that would still be a 5% decline year over year and a third straight quarter of declines. But it would mean that the company was doing better than the first half of the year, where we saw sales down 13%. So next up, I want to take a look at Equifax. This is a really interesting one. Shares plummeting this morning. It might be getting disintermediated to some extent from the Fair Isaac Corporation. So FICO saying late yesterday that it's going to start giving mortgage lenders the option to calculate and distribute FICO scores directly to consumers. Now, that's a threat to companies like Equifax, also TransUnion and Experian, the three big credit reporting firms, and we're seeing the halo effect across the industry this morning. So we'll see if those companies can try to change how they do their business, change their business model to some extent to meet this threat from FICO. Fair Isaac, I should mention, is higher pre-market. And then Fermi, this is a fascinating one. This company was just founded in January, but by former Energy Secretary Rick Perry. It's an energy REIT, and obviously it's aiming to get in on the AI energy story. It's developing energy campuses. It already has 5,000 acres of land leased from Texas Tech. And just to let you know, it also refers to itself as the Donald J. Trump Advanced Energy and Intelligence Campus. So the story with this is it IPO'd yesterday at $21. opened at $25, closed the session up 55% at just over $32 a share. You can see where it's trading at pre-market. It also starts trading in London today. And this all values the market value of this company at more than $19 billion. Not bad for a 10-month-old startup, right, John?
Not bad at all. Not bad at all. We'll have more on that kind of thing in just a moment. Vonnie, thank you. Thank you very much. On a radar this morning, delaying the data, the Labour Department confirming the weekly jobless claims will not be released as scheduled today. This also puts Friday's crucial payroll report in serious doubt as the government shutdown continues. Elsewhere, the Supreme Court refusing President Donald Trump's bid to immediately remove Federal Reserve Governor Lisa Cook, the order allowing Cook to keep her seat until the justices hear her case in January. And finally, OpenAI is now the world's most valuable startup after employees selling about $6.6 billion in stock. That move pushing OpenAI's valuation to $500 billion, propelling the ChatGPT owner past Elon Musk's SpaceX.
I love what you were talking about before, that we used to look at who's the next unicorn at $1 billion. And now I'm thinking about this sort of flock of unicorns where there's like squirrels trying to get rid of them. I mean, at a certain point, you're wondering, at what point does this indicate froth? And at what point is this worthy, given the fact that ChatGPT single-handedly changed the conversation around AI and single-handedly changed the investment structure of a lot of these big tech giants and single-handedly changed the concept of what search was on the internet and is raising questions about the future of internet as we knew it. So on one hand, oh my gosh, froth, bubble. On the other hand, well, it's kind of a transformative moment.
But it does feel kind of like a bubble when earlier this year, this valuation was at $300 billion, and now we're October and it's $500 billion. It's pretty incredible, but also comes at a time when people are saying this might be the right strategy if you don't want to go for an IPO, because it's a way to make sure you're also retaining top talent, because they are getting some of this money back, and you want to retain some of your best when you have the likes of Meta pulling out, what, $1 million contracts?
Do you remember Long Island iced tea? We talked about this just last week. Remember when they renamed themselves?
I remember for lots of reasons. Carry on, John.
On the end? Do you remember
Lisa.
that?
Yes, I do.
Do you remember that?
I do.
They put blockchain on the end of the name, and there was this big rally for those kind of stocks. I remember having that conversation at the time, and someone correctly pointed out to me, don't allow that, the craziness, to distract you from the real things that are going on. And my response to some of that is don't allow the real things that are going on to validate and justify some of the crazy stuff happening elsewhere. And I think you've got to draw a distinction at the moment between both.
Part of the problem is this is sort of a science fiction moment, so people don't know what to believe. I'm just thinking back to the Long Island iced tea blockchain and think about Overstock, a furniture company, a furniture reseller that put blockchain in its name. It said the word blockchain, and suddenly it was, oh my God, the furniture is going to be on blockchain. At a certain point, you are absolutely correct. I think a lot of people are suspending belief because they don't understand the parameters of what kind of sea change we're in.
Some real things going on, particularly over at OpenAI. What a valuation. Elsewhere, the AI-fueled frenzy in capital markets driving record valuations and sparking a wave of deals. Investors weighing whether the M&A sprint will sustain its pace. Joining us now to discuss, the head of RBC Capital Markets US, Vito Spaduto. Vito, good morning. It's good to see you, sir.
Great to see you, Jonathan.
Thanks for being here, buddy. 6 months today since Liberation Day. I don't know where the time has gone. Can you describe what it was like then and compare capital market activity now?
It's been 3 quarters of what feels like 3 years, to be honest. So I think at the beginning of the year, one of the things we published was we said that we expected that everybody came into the year with a lot of euphoria, expecting significant deal flow, very much of a significant upside, less regulation. And we always said, well, calm down. First Trump administration, it took about 12 months to get to a place where everybody was comfortable and kind of knew how to manage in that environment. We thought that it was going to take about 6 months this year, not a full 12 months, and certainly that played out. And if you look at the different quarters, up until Liberation Day and just right after it, there was some concern. But if you look at the volume of transactions, so right now we sit about up 28 to 30%, whether you're looking at the US or globally in terms of announced M&A volumes. It's all being driven by larger transactions that are up somewhere between 50 and 65%, again, depending whether you look in the US or globally. What's interesting is the 3 summer months, June, July, and August, were each in total up 55%. So you just saw a sprint to the races starting in June, and it's continued into September. I think we were talking about whether the rate cut was going to drive more M&A, and my response was always, well, it's already happening. I'm not sure that we're thinking about that. And obviously the news this week, there's the question of does this shutdown impact things? And again, I think there's still a good amount of activity.
Do you consider this activity just the consequence of pent-up demand? Old ideas that have been delayed? Or are these new ideas? Is this new business? Is this the start of things to come?
Well, I think it is a lot of pent-up demand. I think we came into the year with the conditions being very positive for the markets, very positive from a transaction perspective. And there were some self-inflicted wounds in terms of we had to get through some of what the government's trying to do on different policy. And I think now that the companies are feeling more comfortable with where they are and, feeling more confident and aligned between, say, the C-suite and the boards so that they can actually make decisions, they're going back and reevaluating transactions they've considered for some time. And so I would tell you, when you're seeing some of these large announcements that have been happening, those are transactions that have been considered for some time. It's not, just waking up one day and going, well, the next week I'm going to go and acquire this business. It's really, okay, we've looked at it before. Now let's reevaluate in the current conditions. Our board is very educated on this potential opportunity because we've kept them up to date. They're fully informed on the opportunity. But let's update it to today's conditions. Oh, now it aligns and makes sense. So now let's figure out how to finance it, how to structure it, how to make it work in this regulatory environment. Oh, the regulators are allowing larger opportunities. How do we position for that?
Do you like the idea that more of it comes in debt in terms of the financing?
I'm not sure if I would say more of it comes in debt. I would say that it's structured to what the appetite of the market is.
Which is debt.
It is debt, but I also think that, look, I've been at this for over 3 decades. I've seen when the debt component was even much larger than it is today, and then it pulls back to what's more reasonable. I think corporates are much better prepared today than they were, say, when we were in the global financial crisis or 10 years ago, because they understood what happened when their balance sheets weren't as nimble. And so I think they have more cash on their balance sheets. They're able to borrow at better rates. And even with the rates being higher than they were, say, it's still a situation where they're at all-time levels in many cases.
I wonder how much of the M&A activity is being driven by the idea that big companies have benefit right now. They are better able to be resilient in the face of supply shocks. They're better able to negotiate deals. They're better able to potentially get economies of scale. It seems like there is an emphasis on that now in a way that's different than, say, even 10 or 20 years ago. How much is that driving some of this?
Well, I think the key word you said is resilience. I think they're better able to manage their businesses, adapt quickly to external conditions. And so when they're faced with something that they haven't faced before, I mean, look, 5 years ago we went through COVID. And so we went through something that had never happened before. Businesses shut down for a period of time. They weren't able to do business. They had to quickly adapt. They've learned now they need to be able to plan for various forward-looking markets and businesses and be able to be prepared depending on what's thrown at them. And so I look at the large corporates, they're probably best positioned in that than they've ever been in the time I've been in this business. And so as a result, you're able to make decisions quicker. You're able to move when windows open. I mean, right now we're telling clients that the remainder of this year and into the first half of next year, we feel pretty good about the market conditions in terms of driving activity. And, when I look at it, it's, the things that could derail it are some of the external noise, and do you stop and listen to that noise, right? The shutdown this week, if it gets cleared quickly, it'll be a blip, right? Even the shutdown in 2018, 2019, yes, markets came down. They came back and went even higher afterwards. And so I think businesses are prepared to get through it. Now, if we go through a longer period and all of a sudden we get through the end of October and the Fed is making decisions blind without data that they would normally look to, and does that cause companies and boards to say, oh, let's take a pause and wait on this decision? And I think that's the other key thing I see is business and activity is not going away. It's more of a pause. So it's kind of moving to the right. And so, Jonathan, when you say pent-up demand, it's like, well, I've just been waiting to execute on that transaction. I haven't put it on the shelf.
So could the shutdown work as a catalyst, potentially, the way the April 2nd Liberation Day worked in terms of having businesses hit pause?
I think it could a little bit. Again, it'll depend on what we see going forward. Right now, it looks like, I was talking to one of my favorite analysts, Lori Calvasino, last night, and I asked her about poly markets. I said, has Polymarket made a market yet on how long this shutdown is going to be? And I think the leader in the clubhouse right now is October 15th or later, which is kind of interesting. And so she, very nicely pinged me about that last night. I think that, look, I worry about it being too long. I do get concerned in one way about the shutdown, which is it does hurt the IPO market. And so if I think about transactions, oftentimes you want, if you're selling something and you're able to go public, that's a viable competitive alternative that you want to hold out there. And so having less alternatives makes it a more difficult market to execute.
Can we spread the love a little bit, Laurie, Francis, Amy, just so people don't get jealous over at RBC?
I spend a ton of time with Francis and Amy and Laurie.
You're doing great.
And it's all good.
Yeah.
You're out of trouble now.
There's only so many I can throw out.
There's so many different favourites. Vito, thank you. You're one of ours. Favourites. Thank you, sir. Appreciate it. Vito Spaduto there of RBC Capital Markets. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The European Union is planning to boost tariffs on steel imports. The European Commission will propose a long-term mechanism to reduce existing quotas for foreign steel and impose a new tariff rate on imports beyond those quotas. The EU steel industry has faced a severe crisis due to cheap imports from Asia and increased tariffs imposed by the US. President Trump says he will meet with Chinese President Xi at the end of the month for discussions on trade. Trump posted on social media saying that soybeans will be a major topic of discussion, with the crop remaining a key sticking point. China hasn't bought any soybean cargo from the current harvest, instead relying on Argentina and Brazil as retaliation for Trump's tariffs. Two Delta Airlines regional jets reportedly collided at low speed while taxiing at New York's LaGuardia Airport on Wednesday night. According to an ABC affiliate, no injuries have been reported. This is the latest in a string of incidents at LaGuardia in recent months that have prompted federal safety probes. And that is your Bloomberg brief, John.
Nope. Vonnie, thank you. So your face too. Don't want anything to do with that stuff.
I was just thinking about the curmudgeons, the traveling curmudgeons. I mean, that just sort of adds to that joy that you feel when you get into it.
Every time there's an airline story, it's never a good one.
Well, but the truth is, we're publicizing more of them now. They happen all the time. I don't know if that should be comforting or not so much, but, yeah, not
I'm not taking much comfort in any of it. Okay, up next on a programme, signals and the data adding up.
These surveys are giving a consistent signal that we are seeing some more concerning weakness in the labor market. We think that means the Federal Reserve has room to cut interest rates here.
A conversation up next with Kelsey Barrow of JP Morgan.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Nasseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We've got baseball bans. Do you want to do baseball bans?
I like what Vito left the studio saying. The only shutdown he likes when the Yankees shut down the Boston Red Sox, which we did last night. Fantastic game.
So that's game
and
2.
Vito was there, so I'm a little jealous.
When's game 3?
Tonight. Do you want to go?
Okay, no, I don't.
I'm looking for someone to go with.
Okay, if anyone's listening and would like to go to the baseball, maybe you have a suite. I don't know.
Yeah.
I don't think you can accept that.
Yeah, well, depends.
All right, okay, let's move on very quickly. Equity futures on the S&P 500 positive by 0.1%, on the Nasdaq up by 0.4. Under surveillance this morning, signals in the data adding up.
These surveys are giving a consistent signal that we are seeing some more concerning weakness in the labor market. We think that means the Federal Reserve has room to cut interest rates here. They still have rates that are above neutral. Getting back to that is very reasonable. We think they cut interest rates, a couple of more times this year.
So here's the latest this morning. Traders betting the Fed will cut interest rates twice this year after private sector payrolls unexpectedly dropped in September. Kelsey Barrow of JP Morgan Asset Management writing, recent labor market data confirms that slack is still growing. A soft labour market justifies additional rate cuts by the Fed. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
Do we not need NFP tomorrow or claims today? We're just on a one-way street to another rate cut?
I think we probably are. I'm sitting here looking at the echo screen kind of longingly, knowing that we're not going to be receiving that data.
This morning.
Yeah, I mean, it's a bit of a strange feeling. But I do think that we have enough corroborating evidence, whether it be in the ADP data or whether it be in surveys, like the Conference Board has the jobs labor differential, so jobs easy versus hard to get. Those are all really trending very similarly in the same direction, which is slowing. We're seeing it on the private sector side. We have risk of more job cuts on the public sector side coming, depending on how this government shutdown evolves. And so I do think that, the Fed still views policy as at least modestly restrictive. And so there's space to cut rates at least through the end of the year and then pause and reevaluate.
In the quote we used, you used the word slack. Now, we've certainly had a step down in payrolls growth. Have we really seen an increase in slack? Two kind of different things. One can inform the other. But given the supply side developments that we've seen over the past year, how are you measuring where we are with the slack story?
No, I mean, that is a really good question. And I think one of the reasons why the market has been taking the slowdown in jobs growth in stride. Now, the reason that I'm skeptical that we can just dismiss the slowdown in jobs growth as exclusively a function of falling labor supply and falling immigration is when I look at those surveys of consumers, whether it be the New York Fed or the Conference Board, if this was all about just slowing hiring because there wasn't immigrants to fill the roles, then why would respondents be saying that it's so hard to find a job? Particularly those of the lowest income and lowest education level, which is also the area where immigrants tend to be the highest share, non-legal immigrants tend to be the highest share of employment. So to me, I think that there is evidence that it's not just a labor supply story, it is a labor demand story, and there is legitimate reason to to be protecting against the downside risks to jobs.
I buy the story about real weakness in the labor market. You look at the quits data and you look at how much the quits rates come down. A lot of it verifies this idea. It's not so great to get a new job. It's not terrible, but it's not so great. I just wonder if rate cuts are the answer, given the fact that financial conditions are as easy as can be. And ultimately, what rate cuts are supposed to do is prompt investment from companies that already are investing at some of the fastest paces that we've seen in years.
Yeah, so this is a really interesting point about investment. So what I've been doing recently is really trying to understand this dichotomy between the strong growth data, the strong GDP data, and the weak labor market data. And what I think people, not in the equity market, they're definitely appreciating this, but on the bond market side, you know, you've mentioned that it seems like the bond market is looking at the labor market data and interpreting it as this is a bad sign, the Fed's going to need to cut rates more, while as risk assets are saying, it's great, the Fed is cutting rates and growth is still fine, layoffs are still low. What we've noticed is, you know, the GDP data has been very highly concentrated in the AI sectors. So if you look at software investment, intellectual property investment, those are running around a 30% annualized rate in the first half of the year. If you exclude those, GDP growth is actually pretty muted, pretty close to zero, and more in line with the labor market data. So it does go some of the way in explaining some of that divergence.
Yeah, but if you overlay the idea of rate cuts and trying to juice the rest of the economy through the monetary policy mechanism, isn't the risk of a bubble or a risk of some sort of excess that much greater, given the fact that everyone is betting on this and saying, look, they've got our backs, we can buy anything and we can pay whatever we want for it and we'll be made whole?
I don't think that that's a new phenomenon. I think we have experienced a series of shocks over the last 5 years since COVID, where policymakers have shown to the market time and time again that they're willing to step in with unique and unconventional policies to backstop things. And so far, they've been successful.
Are we breaking down the traditional correlation between the labour market and credit? How does this all shape your views about what's happening with fixed income on the credit side?
Yeah, and this does go to this idea that, you know, we talk about the K-shaped consumer, but there's also a K-shape in terms of businesses, you know, and when we're talking about capital markets and IPOs and all of the M&A and all of those discussions you're just having with the last guest, you know, that's only a subset of America. And when you look at the majority of hiring in America, it's done by small businesses. And so our credit analysts continue to look at that subset that is linked to public markets, capital markets, can raise debt, you know, by investors here in asset management. And their balance sheets are solid. So I do understand, you know, why those spreads are tight because of those fundamentals. They have the flexibility to maintain their operating margins. It's just a question of the haves and the have-nots, because if you're a smaller company, you don't have that flexibility to manage supply chains and to absorb the cost of tariffs like the small companies. And that's why you see in the ADP data yesterday, the only area where jobs were growing was in companies with 500 or more employees.
Yep.
The rest of the economy was seeing job losses.
Two different worlds. Kelsey, great explanation. Good to see you. As always, thank you. Kelsey Barrow there of JP Morgan Asset Management. Coming up next, Sarah Hunt of Alpine Saxon Woods, Krishna Gua of Evercore, Yelena Shiratieva of the Conference Board, Mike Pyle of BlackRock. The second hour of Bloomberg Surveillance, just around the corner.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in.
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term
Hello guys, so I will be I'll be out for a while and we'll turn back later. I'll be out for a while and we'll turn back later, but as we analyzed earlier, we were looking to sell GBP USD, and you can see the stop hunt here. We had 1, 2, 3 swipes and the pattern is there. So earliest entry was here and the second entry, so this is a very late entry. However, the risk reward ratio is very good, so it still stands, and the pattern is also good.